Hi, students. My name is Yusuf Kunapar, professor in finance at CU Denver. Today, I'm going to teach you how to use technology to evaluate a company within a few minutes. You don't need to take a college degree or anything. So all what you have to do is just go to my application here, and it's a Bonaparte's Analytics. So I teach you all this analytics that you need, and the website does for you everything using the AI technology. But let's first teach you a few key financial ratios. The first one is earning per share. Suppose the company has a $1 million earnings, they have a 500,000 shares. You divided 1 million by the 500, you get $2 earning per share. So every share you own is going to give you $2. Price to earning ratio, PE ratio, we call it. Suppose the price for the company is $50. Like, for example, NVIDIA today, how much the price of NVIDIA? 127. We go back to our case, price to earnings. So you see the company price. What's the price? You divide it by the earning. I just taught you here how to use it. So price to earning ratio is 10. What does that mean? 10 means for every $1 earning for NVIDIA or Apple or any company you're doing, for every $1, investors are willing to pay $10 for this $1 earnings. So you can see here, NVIDIA, in this case, PE ratio for NVIDIA is 50. That means for every $1 earning for NVIDIA, investors are willing to pay $50. But if you look to JP Morgan, which is a bank, you will see that for every one PE ratio, for every $1 for JP Morgan earnings, investors are willing to pay only 13.88, only $13.88 here for every $1 earning for JP Morgan. But for $1 for NVIDIA earnings, they pay 50. Why? Because they believe the $1 earning for NVIDIA will multiply faster than JP Morgan. So there's more growth in NVIDIA than JP Morgan. That's the reason they're willing to pay more for NVIDIA. Analyst recommendation. So analyst recommendation, every company has a few analysts watching the company. Like JP Morgan ask their analysts to watch Apple, Microsoft, and others. Usually big, large cap companies has more advisor, more analyst recommendation, and they recommend between 1 to 5, 5 strong buy, 1 strong sell. So some people say 3, some people 2, 4, 5, some people 1. So that's analyst recommendation. Company beta, well, company beta is, it reflects the risk of the company. For example, JP Morgan, their beta is 1.09. So what does that mean? This number means nothing. Oh, now I'm going to tell you what it means. The market risk is 1. By construction, the market risk is 1, which is a spider, which is the S&P. We call it spider. The beta for the spider, which is a market beta, is 1. You can see that here. Beta for the market is 1. So NVIDIA, for example, their beta for NVIDIA is 1.66. So what does that mean? Now we know what does that mean. It means 1.66 is higher than the market risk by 66% higher than the market risk. Whereas if you take, for example, Walmart, the risk for Walmart, beta for Walmart 0.5. That means Walmart is 50% of the market risk. If you don't like to take risk, well, then buy Walmart. So that's a beta, company beta. And then capital asset pricing model, CAPM, which is the person who got Nobel Prize, it says expected return equal risk-free rate plus 1.2, the beta, multiplied by market return minus risk-free, and that will give you the return for the company. CAPM calculates the expected return on investment based on its risk. So you start with RF, risk-free, plus beta, 1.2 in this case, multiplied by 8 minus 2. 8 is market return, expected return, RF, is market risk-free, and 9.2 is expected return for this. Okay, so now you know the ratios. You can read more about this from this page, or you can use a ChatGPT to use it. Now, I'm going to have three models. One model is a price-based analyst recommendation, the price-based and CAPM model, and a price-based price-earning ratio. And then you have three models. Every model is going to give you a price for the company. Which one are you going to use? We're going to use the weighting. You're going to give weight for every model and then give you the projected price. Okay, let's do it. So let's start with the first model. As I said, analyst recommendation from 1 to 5. 5 is a strong buy, 1 is a strong sell, and then you see what's the analyst opinion about the company. And in this case, let's use Apple. We're gonna use Apple in all the models. AAPL, use that. So the current price for Apple 189. So you have to make one assumption. What do you expect the market to be a year from now? We expect to be 10%. Every year we expect the S&P to go 10%. We use historical average. So it's going to be 10. The analyst recommendation for Apple, I didn't know. I need to look at that. So there's a website called Park Chart. Park Chart. You put Apple, AAPL. You click on the ticker. And then they give you the current for Apple. In this case, the Apple analyst recommendation is a 3.6. So 1 is a strong buy, a strong sell, 5 strong buy, 3.86 is above the average. And we see here based on 37 analysts. There are 37 analysts. Some people say 5, some 1, some 4, some 2, some 3. In average, you got 3.86. So that's it. You just go there and you say, I want Apple. I say the market is going to go 10%. And I think the expected this will be analyst recommendation is 3.84. That means expected return for Apple based on this model is at 12.8. So that's the first model telling you return is going to be 12.8 and the projected price to be 214. The current price is 189. The second model is CAPM model, which is RF plus beta multiplied by RM minus RF. RF is risk-free, which is a Federal Reserve, plus market company beta, RM minus RF. We're going to continue with Apple. And the market has to be 10. If you assume something, you have to assume it on all the models. Risk-free is 5, the Federal Reserve. Based on this model, we know that beta for Apple is here. We know that from here. So you don't need to insert it. It will insert by itself. Then the expected return based on this model is 11.32. And the projected price is 233. So the first model, the projected price was $214. This model is 211. The third model is a price earning model, which is you divide the current PE ratio with the future PE ratio. What does that mean? I need to explain that to you. The current PE ratio, the price divided by the earning is 42. But if I want to price a company, I don't care about the current PE. I care about the future PE because I want to see the future income earnings for the company. So that's what we're going to do here. So we're going to look to the future PE, forward PE versus current PE. Trailing PE, that means the last 4 quarters. The one on the website, the one here, is based on the last quarter. So there's a slight difference between the PE here and the trailing PE. But either way, slight difference, doesn't matter. So if you divide the forward PE, divide the current PE, price earning, divided by the future PE, that will give you the future price. So you divide the current PE divided by future PE minus 1, that will give you the expected return. We're going to use Apple. And based on that, they're going to give you, so this is not the real data. This is from a few months ago, I get the data. They will give you forward PE, current PE, divided the current by the forward, and you get the projected return to be negative 13.05. So these two models expect Apple to be up, This model expect Apple to go down. Combine is you put all the three models. You're going to say, I need to know about Apple. Again, the market is 10%, risk-free is 5. Then what you have to do, you put the weights, how much you want to give the first analyst recommendation, for how much the second one and the third one. So you can see here 13.77, 11.32 that we done before, and -13. Now, if you are a new analyst, the first time you're doing this, I would put more weight, it's your call, but I would put more weight in the analyst recommendation. Why? Because you rely more on the experts who've been in this business longer time. Apple is a growth company, kind of growth. I will put more weight for growth. So I will put here maybe a 30 here, and here I will make it a 20. So here I will put analyst recommendation maybe 45%, and that's pretty much good for me. And based on that, the projected price will be 197. Access return is -5 because access return is Apple return minus the S&P return will be -85. For me, this is a sell, not a buy company based on these numbers. Let me go again, explain the entire exercise here. I want to analyze a company. I need to analyze this quickly. I don't have time. We have something called AI technology. We have something called machine learning. So all what you have to do is to understand what is that earning per share, price to earning ratio, analyst recommendation, which is 1 to 5, company beta, which is above 1 or below 1. Above 1 means the company is riskier than the market, and capital asset pricing. For every company has an analyst recommendation. 3 is the market analyst recommendation. If you think Apple to be 8.4, you put Apple, ticker AAPL. So based on this model, we expect that return to be for Apple. The second model, CAPM model, which is expected return calculated based on the RF risk-free and the beta of the company. And you get this already inserted in the website, and you get the price for Apple, expected return. And then you do the price earning ratio, which is you compare the current PE with the future PE, and you divide them. So when you divide the current by the future, PE, P divided by E, divided by P divided by E, that will give you the P of the future price, and the E's will be canceled. That will give you the return between the future P divided by the current P, and that will give you, multiply the price, give you the expected return. Now you have 3 models. You didn't know which one to use. So what you're going to use, the weighted model. If you give 50% here, 30 and 20, that's cool. So that's a good, if you're first analyst, first time you do this. So that's a good spread. Based on that, you will get projected price to be 108. Access return, that means Apple average return minus the market return. And that will give you weighted. So the Apple weighted average is 3%. So from these 3 models, one give you 0.33 with the weight 50%, one is 10.22 with the weight 30, but you have a one with the negative that much. So on average, you get expected return 3. The access return means the market return minus access return 10 minus this, that will give you 2.33. So we expect Apple price to be 204. The first model give you 13.77. The second model give you 11.32. You didn't know which model to use. The third one is a -13, so you didn't know what model to use. Therefore, what you have to do is just change your weight, and then you can see. Like, for example, if you put more weight here, it's going to take it from some other ones. You can take here more weight. So then the price going up, the access return start become to be more near 0. If you more of this, see, the more you put here, then the access return. If the access return become to be positive, then the company is buying. If the access return is negative, that means sell. What does that mean, positive access return? That means the company you analyze expected return is higher than the market. But if the company you analyze, its expected return below the market, then it's a sell, because I can buy the market portfolio and have a better return. So what we've done here is we taught students, we teach you how to use AI technology to analyze a company in a few minutes. That's it. As simple as that. Thank you so much. I hope you enjoy it. If you have a question, let me know. And my email is joseph.bonaparte@ucdenver.edu, and you can find me in the net. Thank you.